Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the Fed's decision to keep policy rates unchanged this year. It's no secret that economic worries and the trade war have led to market swings in recent weeks, so the Fed's reaction to all this uncertainty was closely watched by investors. While Fed Chair Jerome Powell attempted to provide a balanced view at his press conference, the Fed has expressed increased uncertainty about economic conditions amid higher inflation and unemployment expectations. Over the next few minutes, we'll dive into inflation, interest rates, and the Fed's attempt to achieve the right balance to meet the current economic moment. First, this chart shows the 2-year and 10-year Treasury yields alongside the federal funds rate with recessions shaded in blue. As you can see, the Fed funds rate is correlated with market cycles, rising as economic activity accelerates and falling during recessions. So what does the Fed's current policy stance tell us about the economy and vice versa? The Fed paused its cutting cycle in 2025 due to concerns about tariff-driven inflation and underlying economic strength. Inflation has been stubborn but relatively stable, with the CPI at 2.8%, PPI at 3.2%, and PCE near 2.5%, and all above the Fed's 2% target. The Fed maintained its outlook for 2 rate cuts in 2025 despite increased uncertainty from tariffs, balancing its dual mandate of stable prices and full employment as it tries to find signal through the noise. Next, this chart shows rate projections by the Fed according to their latest summary of economic projections. This is often called the dot plot since each dot represents a member of the Federal Open Markets Committee. It shows that the Fed expects to cut 2 more times in 2025. Similarly, the markets expect 2 to 3 more rate cuts in 2025. However, it's important to keep in mind that these expectations can change quickly. In 2024, forecasts changed from 7 or 8 cuts to the 3 cuts that actually occurred by the end of the year. In the same projections, the Fed also lowered its forecast for GDP growth to 1.7% in 2025, the first time it predicted growth below 2% since the high inflation and rate hikes of 2022. This is one of the many reasons some investors believe the Fed may cut rates more than it currently appears. Finally, high rates makes holding cash appear attractive, especially when markets are volatile. However, traditional cash vehicles typically offer inadequate returns once inflation is considered. This is because higher prices erode the purchasing power of cash. While cash may feel safe, it's neither a long-term solution for income, nor does it provide portfolio growth. What's interesting is that traditional longer maturity bonds have performed better this year and have helped to support portfolios amid stock market uncertainty. Despite short-term volatility from policy changes, focusing on long-term economic fundamentals is the best way to stay on track to achieve long-term goals. We hope you found these insights helpful. If you would like to discuss this topic in any more detail, please don't hesitate to reach out. We look forward to speaking with you soon.